Hey guys, you're listening to the Tascha Labs podcast. And as I mentioned last time, today I want to do a Q&A about some questions I received about the topic that we covered last time, which is how to be in sync with market cycles or the market rhythm. Okay, so I got some interesting questions and I will be covering several of them, including one question about how do you balance like being a contrarian versus going with the market flow. Okay. Secondly, there's a question about how can you also use some of the like market cycle indicators to apply to individual stock or ticker or token. And thirdly, there's a question about is it a good idea to build models to automate some of the like these market cycle judgments? And lastly, I want to cover a question someone asked about longer term crypto cycles and how I think about like long-term investing for crypto, for like a Bitcoin, Ethereum, that kind of thing. Okay, so those are basically the things I'm going to go through today. And first question, it says, you advise to go with the market trend, but the best investors are contrarians? Really? Like Warren Buffett said that when everyone else is losing their head, you should keep yours. How do you balance between being a contrarian and going with the market trend? So, so first of all, I don't even know what a contrarian means unless you give me a very specific definition of what this person do. What does this person do in situation A and what does he do in situation B and that kind of thing? Like very like quantifiable action. Otherwise, I just don't know what this means. You can, people can post on Twitter all day long, oh, market's too high, market's gonna correct, or we're at the bottom. People can spit out opinions all day long, but unless they have an action plan attached to that opinion, then I don't know what it means when you say someone is a contrarian. And is he always a contrarian, or just at some step of the market cycle that he becomes a quote unquote contrarian? Because I can tell you, if you, for any type of investors, right, no matter what your strategy or framework is, at some point, if you're doing your job about your market cycle analysis, you will realize, okay, maybe this is the point and market will start to turn. And because you start to see some sign of like market cycle turning, but maybe the majority of the trend, if you look at the price action, is still going in the way of the previous trend. Do you call that a contrarian? But you don't make that decision. You don't do that kind of judgment call every day, right? That's actually a relatively rare event. So, and also that's one. It's like there is no saying like you are contrarian and once and for all, you are always a contrarian. Maybe there is a point based on your market cycle judgment and your framework, your assessment is that at current level, maybe this price is going to correct, or the opposite, and the price is going to bounce. And you have a strategy attached to it, and that is different, depends on what kind of investor you are, depends on your framework, right? So like, for example, if you see like the COVID-19, like in March 2020, market was in free fall, right? So some people were shorting the hell out of the market, but at some point, maybe your market indicator says, well, the market is oversold. We're going to be ready for a bounce, guys. So we are, so then our execution plan is to not initiate any short positions anymore and get ready to cover our existing positions if we see signs A, B, and C. Okay, so that is a very specific action plan according to a very specific market judgment in terms of where we are at the cycle. Do you call that contrarian? Because the market may be still falling, but you see some sign of market turning, right? But as opposed to maybe another type of investor who's more like a hardcore value investor would say, we'll have the same judgment about the market. Say, okay, we think market is oversold here. it's overreacting and it's overreacted too much, and now it's a good opportunity to start looking for drastically undervalued asset to get them at a cheap price. And then that would be your action plan, and you start looking for that type of things. But that will be a very different action plan compared to the first type of investor, even though you have broadly the same assessment about the market, right? So which one do you call contrarian? So I just don't find these very broad adages and general advice is helpful unless you put them in a specific context, and because they're just not specific enough. Okay, so it's just like to me, like they're just like, if you are like always contrarian, you are out of your mind, because what does that mean? If being a contrarian meaning like you are always going against the market, you are definitely insane, because for example, in the past, like S&P has existed for almost 100 years, right? So in like 90 something years of its existence, 70 to 70% of the time, the S&P index ends up green on the year for like 5% and above. Okay, so that means if you're like being a quote unquote contrarian going against the market, 75% of the time you're losing. Right. So there's no such thing. You said like best investors are contrarian. I don't think so. Best investors have framework. Okay, they go with their framework. Now, if you have a market judgment in terms of, okay, the market is oversold, or it's like your judgment it's likely to bounce, and your action is okay, cover the shorts or to look for undervalued opportunities. Those are very specific. Again, those are something that you can make a assessment on, because those are very specific action plans. Now, maybe you're wondering, can you do both? Can you like cover your short, like short the way down when the market's going down, and then cover it and start looking for undervalued investment opportunities on the way up? Of course, theoretically, you can totally do that. But then, theoretically, you can be a brain surgeon, a heart surgeon, a family doctor, and a gynecologist all at once, right? But the thing is, any type of investment framework, you will need to really, dig into it to get good, right? Otherwise, if it's so easy, then everybody will be able to beat the market. But the truth is, very few people beat the market, right? So if you're going into the field of brain surgery, you have a general knowledge, above average knowledge about medicine in general, but you really have to dig deep into how to do brain surgery, right? So if that's your chosen field. And the same thing with investment is I think you've got to figure out who you are, right? Are you the type of person who's really into like shorting the top or shorting the weakness, or are you really into finding the bargains in the market? What your personality and fundamental worldview is, if you get a good grasp of that and align your strategy with that, I think you have a better result comparing to just trying to implement every possible strategy under the sun, right? So that's that. So like, for example, like I personally, I told you last time, like I like to buy strength. I don't like to buy weakness, right? Because that's my personality. I'm an optimistic person. I think the future is better than today. I have a positive outlook about the world and the economy. So it's like, it's uncomfortable for me to, it's just like goes against my nature, goes against my instinct to look for like undervalued, like really beaten down opportunities, or going massively going out of my way to short a market when it's in a bubble. Can you make money that way? Yes. Is that something that, according to me, that I do very, very well? I don't think so, because that's not my instinctual way to look at the world, right? Versus someone like, I don't know, Michael Burry, for example, that guy that made famous by this movie Big Short, right? So because because he made one call about the 2008 crisis. Now like people takes him very seriously. But the thing is, the guy obviously is just like he really enjoys being a perennial contrarian, right? He enjoys like seeing the gloom and doom about the world, and he enjoys being like different for its own sake. If that's your personality, then you go for that type of strategy, right? But that type of strategy, does he make money like majority of the time? No, because like I said, 70% of the time, market's gone way up, right? So, but if he can make like 10 bear calls, but maybe like one or two hit the center, that is like a once in a decade thing, and he can still make money, right? So there are all sorts of ways to make money. Even though the rest of the time he's wrong and he doesn't know what he's talking about. But still, my point is you got to find your personality and what works for you. And above all else, you should have a framework, right? So based on what you think you will excel, instead of listening to these, sayings like general advices from famous investors. Second question, some of the indicators you suggested in your last video equally apply to individual stocks and not just market indices. Can you just decide on buy and sell points for stocks or crypto tokens rather than applying it to market cycle analysis? Wouldn't that be more straightforward? Yeah, I mean, some like technical indicators, like for example, some like overbought, oversold indicators, so things like moving averages, so you can apply to individual stocks too, right? And people do that, but I don't think that is a substitute to having a grasp on where we are in the market cycle. And also there's a difference here, okay? When you apply those indicators to individual tickers, and I think this is a significant caveat, because the market is way more stable most of the time in a stable regime in terms of how it behaves compared to individual stocks. Unless you're talking, because the individual components of like a S&P 500 or a NASDAQ may change from day to day, but the index it's always there, right? It's been around for so long, and it continued to behave in not in a totally predictable way, because otherwise everybody will get rich, but it has irregularity, right? It has it has certain patterns that you can discern to a certain extent, versus individual stocks, unless you're talking about like a really like a large cap stocks like never move. Unless you're talking about things like a Caterpillar, or I don't know, like a Johnson & Johnson, or like one of those large cap stocks that basically just never does anything because the company has been there forever and they have very set business model. Nothing goes very right or very wrong very much most of the time. In other words, that stock has a very predictable personality. Otherwise, if you're talking about like stocks that you would actually interest, that will actually interest a growth investor, right? Like me, if I'm interested in a certain stock or a token, it's because I see a growth opportunity. That by definition implies that at some point in this ticker's lifetime, there will be some kind of regime change, right? So maybe it was dormant because the growth was not taking off, and then at some point it crossed a Rubicon of like baseline growth threshold and just started taking off. You saw that for example in actually, if you look back the history of all major tech stocks, like household names now, you look at Amazon, Facebook, Tesla, all these stocks, you go back to the original days when these stocks just IPO'd, and how it went along after that, you realize at some point that stock just took off, but before that it didn't do much of anything, right? So if you use the same type of framework and indicators that you use to analyze a stock before, like in its pre taking off life. I don't know, what do you call that? It's not going to apply very well to the stage of the life cycle when the stock has taken off, right? So my point is, if you look at individual stocks, I don't think you want to apply the same indicator, use them in the same way as you would applying a market cycle analysis framework, because individual stocks have different, have way more volatile life cycles, at least those ones that are worth investing in. Okay. So, but can you use those indicators if that's your framework, if that's part of your framework? Yeah, sure. But that's just a caveat I want to point out. And also, I don't think that is a substitute for having a framework, at least a simple one, about to help you assess where we are in the market cycle. But the thing is, once you have that assessment, you want to have an action plan, right? You cannot just say, oh, I think market is topping here, we'll see, and then just sit there and do nothing. Of course, you can do that, but that is also a choice, right? But you should have a very specific assessment that is linked to your framework of investing in specific tickers. Like, for example, if you're doing like a medium-term investment, you may look at, if you're like investing in some growth stocks, you may look at the NASDAQ, you say, okay, right now I think we are like short-term topping. We are, you know, I see the 10-day moving average has crossed over to the downside of 20-day. And that means, in my framework, that means I should stop initiating new long positions. And if I see another bearish indicator for the market, I will start like getting out of my existing positions. So that type of thing, like basically some type of very specific linkage and action plan to associate your assessment about the market with the like entry and exit decisions, associate with specific tokens that you own, right? So okay, so that's that. Next question, is it a good idea to build a model with market cycle indicators and make predictions automatically instead of manually? I mean, what do you think people on Wall Street analysts do all day long? That's what they do. It's like building all sorts of models, right? For both for the market in general and for individual tickers that they're interested in. So there are armies of people do this as their sole job all day long, is to build models. So yeah, of course, you can build models. However, I think this is something that you need to keep in mind. Okay. So if you look at what do models do? Now, there are different types of models, right? There are all sorts of approaches to build a model that can take a bunch of inputs and tell you, okay, according to the model's opinion, are we going up or are we going down or sideways? Okay, so but there are a lot of different kinds of things that you can do. I would say, in my experience, if you're doing something that is very simplistic, like assuming some kind of linear relationship among your variables, like for example, if you just feed those overbought, oversold indicators into a linear regression and try to use that to tell you what the market would do, I think that type of thing, you can save your time. Okay, I think it's just too simplistic. You might as well just eyeballing a chart. Okay. There are, like, if you do like more complicated models, like if you want to do some kind of deep learning neural network type of thing that take into account some nonlinear relationships among variables, that may help. That may be more helpful. Okay, that may be better at recognizing patterns that your eyes do not recognize, because essentially all of those models do is just pattern recognition, right? And you yourself, you have a neural network and a great one in your brain already that can also do pattern recognition, but it's just like the form of input that your brain takes versus the form of input that a deep learning model, a computer model takes is different. And the way the model on the computer process that pattern versus the way your brain process the pattern is different. Your brain may be more visual, so that's why, you know, people all want to look at charts, because that's a visual pattern, very straightforward for your brain to process, while computers have a harder time. But if you feed computers a bunch of, you know, sequences of numbers or arrays and matrices, that it has an easier time because that's the way it processes information. So it may, I mean, that kind of model may help you to detect some patterns that your eyes with a visual information processing modality may not detect, and that may give you some fresh information. Okay. So I think those type of model worth a try. Have I tried them? Yes. That's what I'm telling you. Okay. So but the thing is, I think here's the limitation. Okay. I think one big limitation is, how do you feed that information that you have into a computer model when the information cannot be expressed in a super quantitative way? Okay. So because like last time or a couple episodes ago, I used the analogy of, you know, how do you tell it's spring? When you stand outside, you can immediately tell spring has come, right? So, but that's a lot of nonlinear information processing, and those information may not be entirely quantitative, right? So how do you feed all that information that you know to a computer? And keep in mind, if you do this long enough, a lot of times that information processing becomes a very subconscious process. You don't even know what information you're taking in, right? So, but you need to feed that to the computer, right? So like a good investors, if they have been doing these kind of thing for a very long time, like discretionary investors, right? They can look at like a NASDAQ chart and they may have a judgment in terms of, okay, I think we're going to have a correction. I think the correction will be X percentage point. And you ask them why. They give you like a few reasons, but then you sometimes like those reasons are not the whole story. What they tell you is the part that their conscious mind can pick up, right? But a lot of the processing already goes subconscious once you do this for repeatedly for a long time. So it's only those conscious part of information that you are aware enough to feed it to your computer model, right? So what about the parts that you're not even consciously aware? So, and also what about the parts that are not quantifiable? For example, if we look at the NASDAQ, okay, so you may look at some quantitative technical indicator to say, okay, we're going to have a correction, right? So maybe we've seen a top for this summer, but how big the correction is going to be? You may have a qualitative judgment. You may say, well, I think this correction is going to be bigger than average because you see we've been in the market, like we've had like once in a decade bear market last year, but it really hasn't gone down that much, even though the monetary tightening has been pretty at a historical level, right? Has been pretty drastic. And then this year, you have the market like went up 7 months straight. It's not entirely straight, but there's like the correction was very light. And also like at this point, given that, you know, the monetary environment is not really improving. If anything, you probably expect that, you know, the interest rates to stay elevated for a longer term. And then interest rates are also being pushed up because the US government the fiscal policy is very expansionary right now. So they have to borrow more money that pushes up interest rate. And so you look at things, but on the other hand, yeah, they support the economy in the short term. But you look at this saying, maybe your judgment is like at the qualitative level, you know, there's no like macro environment is not becoming more market friendly. And the AI frenzy we've had for a few months is kind of running out of steam. You can see as a reaction to the NVIDIA earning this past week, that reaction was very telling, right? So NVIDIA posted this like really superb earning and then market sold off. Market was like, it got excited for 2 minutes and then sold off. So give you some signs about like the environment we're in. So you may say, okay, combining all these information together, my judgment is we're gonna have a sizable correction. How do you feed all that in a quantitative way to a computer model? That's something you need to think about, right? So I'm not saying it's not doable. Of course, if you dig into it, think hard enough, there's always a way, but that's just something I think you should be mindful if that's the route you want to go down, right? But in any case, I think like models will be helpful. Yes, it's a helpful thing if you actually serious about it. But then is a complete substitution of your discretionary judgment? I don't think so. Because again, you have a superb neural network in your brain already. Why not use it? This is not the kind of thing you want to outsource to your virtual assistant in India or outsource to ChatGPT, right? So because it's quite essential to your investing process. And also it's a skill that you actually want to build because that will eventually become part of your edge, right? That other people with similar computer models don't have. Is that discretionary judgment that using the neural network in your head, which only you own, right? You have the sample data, you have fine-tuned the model over time, and that is entirely proprietary software. Okay. So why not build that? Why not build that skill? So yeah, so that's that. Okay, software model question out of the way. Next question, what's your outlook for longer term crypto cycles for long-term investors and not just for the traders? Is Bitcoin having enough impetus for another bull run, or was that a low interest rate phenomenon? What's your updated thoughts on Ethereum? Okay, so longer term crypto cycles, is Bitcoin having enough? So like last time we talked about like supply and demand curve in the market, right? So if you want price to go up, either it's because supply goes down or demand goes up, or it's both, right? But one does not exclude the other, right? You can have both happening. And then but as a rule of thumb, like I also mentioned this last time, I think it generally it's the demand factor, demand going up. That's the factor that would drive a more explosive move up. Okay. The supply factor tend to be a slow burn. You know, you don't see it. It's a slower, more gradual process. Its price on its effect on price. So that will be my rule of thumb. Okay, so then pertaining to these halving cycle per se, that is a supply side factor, right? So supply, if there is a negative supply shock of this asset, you suddenly, there is much less supply compared to before, given that the demand condition is the same as before. Would that have a positive impact on price? Yes, just mechanically, right, over time. But again, that is a slow burn factor. So, but for that kind of explosive bull run to happen, that as we've seen in 2020 and 2021, was that entirely because of Bitcoin halving? Definitely not. Why? Like, to me, that's definitely not a supply-driven phenomenon. At least for the majority part, I think it's a demand-driven phenomenon, right? Because you have COVID, government check, like giving people a lot of free cash that they have to invest in something. And then you have people staying at home and, trying to do investing. And then you have also the very, very loose monetary environment. You have low interest rate, very easy to borrow money. And you can do the carry trade, right, very easily. You can borrow money at low interest rate and invest in riskier asset, and legions of people do that. So all these factors together is a very dramatic demand push that caused a very dramatic cycle bull run up for all sorts of risk assets, not just cryptos, right? So so to answer your question, is Bitcoin halving a factor? Yes, I think so. And do I think that will continue to be a factor? Yes. Leading to cycles. But then for the really explosive cycle, you really need a demand factor. Then you've got to think about, where does that demand factor going to come from, right? So are we going to see the same? The 2020, 2021 is really like all the stars aligned in terms of everything was supporting demand for risk assets, right? So are we going to have another similar all the stars aligning scenario? I don't know. Okay. I think that's pretty rare phenomena. So if we just go with the baseline case, let's say that part doesn't happen in the near future. We never say never, right? Anything can happen tomorrow. But just like if I'm thinking about my baseline, I don't expect that to happen again in the short term, which means, yes, you will have the supply side factor, but the demand factor will be weaker compared to the last bull run that you see. So then the natural conclusion is what? Yes, you will have an upcycle for crypto, but it will be smaller compared to the last bull run. So I'm just telling you, given these are the baseline assumptions, what the kind of conclusion that you will reach seems like very straightforward conclusion, right? It's not, I'm not like pulling a rabbit out of a hat and telling you something that you don't already know. So, so where does that demand factor will come from? I mean, that Bitcoin halving thing itself, it's become such a meme, right? So you see, like, there are people talking all day on like Reddit, Twitter, and whatnot, telling people, oh, the halving is a thing. It's going to be the next bull cycles driver. Like, people believe that, right? So that in itself is a demand driver, right? It's a demand created from a meme that's created by the supply factor. So then people will be positioning accordingly, right? So as long as you have sufficient number of people buys into that story, there will be a demand push, and that demand push, maybe it will trigger another reflexive cycle up, right? So, but but we won't have the free cash like an airdrop by government. We won't have like super loose monetary conditions for a while. So those are the things that goes against the explosive bull move. Okay, so so that's my view on the Bitcoin halving. I think bottom line is I think the bull run is you got to both sides, both the demand side and supply side participating. Okay, like contributing. What's your updated thoughts on Ethereum long-term investing? So again, like when people asking questions, like you use like a really loose and vague terms like long-term investing. I don't even know what that means. How long is your long-term? Okay, like if you're a short-term trader, then holding a position for a week, that is long-term investing. Okay, so if you're like a billionaire and you cannot get in and out of position very easily, maybe like holding an asset for 10 years or 20 years is long-term investing. So you again, like same thing with like a framework, and your like a strategy specific action steps attached to a framework. I think we need to define these things more specifically in order to make sure we're talking about the same thing. Okay, otherwise it's just not very helpful. So since we don't know who the hell, like we don't know whatever that means, whatever long-term investing means, I'm gonna make some assumptions here. Okay, let's say you want to invest. let's say you want to hold a position for the next I don't know, 5 to 10 years, and you don't want to look at it every day. Okay, maybe you can look at, maybe you are willing to look at it like once a month, that kind of thing. So if that's our definition of long-term investing, then is Ethereum a good candidate, or is any other crypto tokens a good candidate? Well, how about we do this? Instead of give a yes or no answer, instead of we just like recycle a bunch of crypto narratives, we can look at this thing from ground up. Okay, so let's construct this long-term investing decision from scratch. How about that? Just like forget everything you know about crypto or Ethereum for now. But the thing is, I think I talked about this before. I think that like this time horizon, if we're talking about 5 to 10 years as the definition of long term, this type of investing to me is way more risky, like way riskier compared to a short-term investing counted in days, weeks, and months. Why? Because I know it feels the opposite, right? It feels the opposite. It feels like short-term is riskier because things move like things are volatile in the short term. But the thing is, why I think it's riskier, it's a opportunity cost of risk. Okay. It's like I mentioned this before, if you're doing short-term investing, you have very short feedback loop. You can learn from your mistakes very quickly, and you can know your strength and weakness very quickly if you're paying attention, right? Because you have, if your investment time horizon is counted by weeks, and then you have very good idea about how you did in the past 2-3 weeks, right? That give you feedback immediately, and then you can adjust accordingly. Versus if you're making one investment decision every 5 years, you don't know how much you suck until like 5 years later. Okay, so how many 5 years do you have in your life? So the long term and short term will be equally will would not have a difference in risk profile if your life is infinite, right? But if your life is finite, you know, how many feedback loop can you go through? How many adjustment and revision to your strategy can you go through if your time horizon is 5 years or 10 years? So by the time that 5 years passed and then you realize, oh, I picked the wrong horse, there are much better horses out there. You already lost 5 years. Okay. So, and also that's why I think, you know, I told you my goal is to live to 120 years old. To me, that's something, if you're like serious investors, it's something you should want to strive for, because this is a profession that essentially the longer time horizon you have, the longer time series data samples you have, the more of an edge you have, because you have longer time series that's your sample data, that's your training data, essentially, right? So you have more training data, you have more material, more stuff you can train your neural network with. So, but let's go back to this question. Your time horizon is 5 to 10 years, and then, okay. So let's see, because we are, so then our task is to say, okay, if this is our time horizon, what are we going to invest in? Okay, are we going to invest in Ethereum or some other alternatives options? So because to do everything, we need to have a framework, right? Otherwise, if you don't have a framework, you know, most investors don't outperform the market. If you don't have a framework, you're even less likely to outperform the market. You might as well buy an index fund. Okay, so let's apply a framework, like a simple framework, to this question. So if we are going to pick candidates for 5 to 10 year time horizon investment, how are we going to do that? We'll need to set more limitations, right? So if we're comparing things to Ethereum, so Ethereum market cap is like 200 billion right now, about, and at one point it was like over $500 billion at the top of the last bull cycle. So if we so let's say we want to compare it to compare Ethereum with other things, other risk assets that are sort of in the similar league as Ethereum. So then that means, let's say we have additional criteria to say we are only going to look at assets that are 200 billion market cap or up to facilitate our comparison, right? Even though in reality, I don't know why you would do that, because if you're a growth investor, so let's define, like, the only reason that you would pick like something, you would set that kind of criteria, is if you just want some growth, but you want to minimize downside risk, and your assumption is, okay, larger caps have lower downside risk. If that's your assumption, okay, then it's safer, quote unquote. So maybe that's why we in this particular framework, we are going to say, okay, we're going to invest something that is, we're going to pick something that's like above $200 billion in market cap. Okay, we don't want to look at the small caps because those are too risky according to our assumption. So then, but we also want to maximize growth, if that's what you want. I'm making some assumptions here, okay? So then let's say, how are we going to do that? So as I talked about in one of the previous episodes, for you to have an investment framework, you need to have some essential things where you want to have criteria for how you're going to pick the thing that you identify the thing you're investing in, and you want to have criteria for entry and exit, and you want to have criteria for stop loss. So your downside scenario, what define your downside scenario, and how are you going to do about it in your downside scenario? Okay, so those are basic elements that you need to have. So let's go through it. So like, first of all, how are we going to identify this our candidate, given that our goal is to seek growth but minimize downside opportunity, minimize downside risk? So then maybe your criteria would be, I'm going to look for stocks or tokens or any asset that is the category leader that has a large moat in a category, meaning a sector or industry that will see the biggest growth opportunity in the next 10, 20 years or 5 to 10 years, whatever your horizon is. Okay, so basically we're going to look for industry leader in top growing industries. Okay, so that's a very simple, straightforward criteria. And we can just then we can go down a list of potential candidates we have and see if they fit that criteria. Okay. Let's look at, because this is like, if our baseline limitation is we can only look at 200 billion or up kind of market cap asset, it's really a very limited list. And in the world, there's right now, I'm looking at this list of large cap companies. There are like about 50 of them fit that criteria. Okay. Aside from these like a Bitcoin, Ethereum type of thing. So we can go down the list and see if each of them meet our criteria. Number one, market cap, Apple. Is it a market leader in its industry? Yes. Is it in a top growing industry? No. Because smartphone, computer hardware, is that a top growing industry of the next 10, 20 years? I don't think so. Okay. So Apple out. Next, Microsoft, is it an industry leader? Yes. Is it in top growing industry segment? No, mostly no. Well, you can say, well, Microsoft is getting into AI kind of stuff, but Microsoft is way bigger than AI, right? So I would say this is a soft no. Okay. Saudi Aramco, which is oil and gas, that's immediately out, right? Because oil and gas is not a top growing industry and sector anymore. Next, Google, is it an industry leader? Yes. Is it in the top growing industry? I mean, it created its own category, which is the search engine, but is it a top growing category? No. Okay. They might transition to other things. They are always looking for other opportunities, but they are not leader in those. Okay. So to me, that's a no. By the way, you don't have to agree with me, obviously. That's like, I'm showing you how I would think about this. You don't have to agree with my judgment. Maybe you think Microsoft is in the top growing industry. I don't know. Okay. Next, Amazon, is it industry leader? Yes. Is it in a top growing industry? No. So already we eliminated 5. Okay. Nvidia, is it an industry leader? Yes. Is it in a top growing industry? I think so. Yes. Because that's AI. Can it grow? Would it be a top growing industry for the next 10, 20 years? Yes, I think so. So Nvidia is a candidate we're going to keep. Okay. Berkshire Hathaway, is it industry leader? Yes. Is it top growing industry? No. Out. So Tesla, is it industry leader? Yes. Is it a top growing industry? Yeah. Renewable energy, EV, kind of climate transition related to industries. Will they be a top growing sector for the next 10, 20 years as the planet Earth is going through a climate transition? Yes. So Tesla is a candidate. Okay. Meta, is it an industry leader? Yes. Is it top growing industry? No. Eli Lilly, is it an industry leader? Yes. Is it in a top growing industry? I would say, to me, I would say yes, because it's in an industry which is like weight loss, diabetes cure. That is a category that is definitely going to be fast growing. Like half of the Americans can use their drug. Okay. So to me, that is a yes. 80% yes. Okay. So basically we go through these top 10 market cap already. You can go through the rest. You can go to like go through these rest of companies and you can make your judgment. But I can tell you, as far as I can see, most of these companies like above 200 billion market cap are not going to be investable according to our specific criteria, okay, which is like two criteria for picking the candidates are not going to be investable for because they don't fit both. So, but anyway, from the top 10, we now have what? NVIDIA, Tesla, and Eli Lilly. Okay, so please don't post in comments. Like you can say like, okay, NVIDIA is like pulling forward their earnings. It's not going to grow very fast in the next year or next 5 years. The Tesla has so many competitors and their margins declining. Yeah, sure. I mean, again, you don't have to agree with me. If that's your judgment, you feel free to apply whatever framework you have. Okay, I'm just telling you, according to these two criteria, these are things I will come up with. Is like from the top 10 market cap, I will pick 3: NVIDIA, Tesla, Eli Lilly. Okay, so and then you compare these 3. So these are like you compare these with something that we were originally interested in, which is Ethereum, which has like a 200 billion market cap right now, right? So then let's say our investment, what's our next element of our framework? We need to look at what's the entry and exit criteria, right? So let's say our entry criteria is buy the dip. And then you've got to define what a dip is. How do you quantify a dip? Then we can go into that. We're not going to right now. So and then the exit criteria, you can define it as, okay, since our selection criteria is those 2 industry leader in the top growing industry, if any of those 2 is no longer met, then I'm out. Okay, so either if this ticker is no longer a top industry leader, or this ticker is in an industry that is no longer a top growing industry, then I'm out. That's my exit criteria. So then similarly, you can define your stop loss. Okay, can have some criteria for that. So that's our framework. So according to this framework, would you pick Ethereum? That's something to think about. Okay. So again, if you think about our 2 criteria, top industry leader is Ethereum, and is it a top industry leader in blockchain, public blockchain, and decentralized computing? Yes. Okay. Is it in a top growing industry? Well, that is the part that I'm a little iffy. Okay. Because I think is the Internet of Values gonna be top growing? I think so. But the thing is the public blockchains, the current infrastructure as we know it, is it gonna be the infrastructure to support the Internet of Values? That's the part I'm not sure. Okay. So that's why I think according to these 2 criteria, something like Ethereum, it has a little bit different nature of risk compared to the other things that we mentioned, NVIDIA, Tesla, Eli Lilly, okay? Because all these other 3, at least to me, I can see a very straightforward path of how this industry is going to continue growing. And it's going to have a very, very big addressable market, okay? Which being AI, renewable, and what is it, like diabetes, weight loss, whatever else they're doing. Okay, so these things, that market is top growing market. I don't think there's any question about it. Okay, Ethereum or any other like blockchains, that is the part I'm not so sure. I'm not so certain. Okay, so because the internet values a lot of the like tokenization concept, like on-chain assets, that tokens that are can interoperable with other with others that have like in the same liquidity network. Those things you don't have to use a public blockchain to implement, right? And so and also there are a lot of baggages associated with the existing public blockchain infrastructure. There are a lot of baggages in terms of negative perception, because there is so much security breach, so much fraud, so much negative stuff associated with this set of infrastructure. And there's also, you know, regulations going to be catching up, right? And then the nation states and other like financial sector players, they want to build their own tokenization infrastructure as well. So all in all, is it possible that public blockchain will become the infrastructure of the Internet of Value? Yes, it's possible. Do I have the same confidence as I have with as the level of confidence I have about AI or renewable energy or weight loss, like diabetes? No, I don't. Okay, so, but for you, you may have a different judgment. But I'm just saying, from this framework that we're just talking about, if we are going to, if you're doing some investing, whether it's long term and short term, you need a framework, right? So once you have a framework, I'm presenting you a example framework, and you, according to this framework, you judge things, evaluate things as objectively as possible, right? Try to be objective. So even though none of us can really look at things, you can argue objective opinion does not exist. If it's an opinion, it's already subjective. So anyway, so that's why I think Ethereum has sort of a different risk compared to other like same other risk assets at a same market cap level, so to speak. Okay. So that means if that's the case, if that's our conclusion, is like, okay, this thing is riskier. Okay. Then the next question is, that does not mean that that's something you can invest in long term. But then the question is the upside gonna be more than compensate for the risk that we just talked about, right? At least, is it gonna be the upside? Is it gonna be significantly bigger compared to the other candidates we just mentioned, right? To compensate for our additional risk. So if we look at NVIDIA right now, it's like 1.1 trillion market cap. Can it go to 2.2 trillion, 2.5 trillion? I can see that. And I think that is a greater than 50% probability event. So I can see NVIDIA double, basically. That is a possible scenario. And that's a scenario of greater than 50% probability for me. Okay. For you, it may be different. Okay. So you gotta make your own judgment based on the information, however you get the information. Okay. Tesla right now, it's like 750 billion market cap. Can it go to the market cap of Apple, which is like 2.7 trillion right now? So that will basically mean the thing need to go like 4x, right? About 4x. Can I see it go 4x? Go to like roughly $1,000, maybe a little bit less than $1,000. Yeah, I think so. To me, that's also a greater than 50% probability event. Eli Lilly right now is like 500 billion market cap. Can I Can I see a double from here? Can it go like a 2x? Maybe. Given time, would not be a straight path because it's gone up so much. But if that's our baseline, so then basically Ethereum need to do, if let's say we're gonna pick between Tesla and Ethereum, and according to our assumptions, Ethereum has a higher risk profile compared to Tesla, then it needs to do more. It needs to give us bigger upside compared to Tesla, right? Can it give us bigger upside? Well, I think that's your judgment. That's a judgment call you need to make. Can it go above 4x? If our baseline for Tesla is 4x, the Ethereum need to go like 5, 6, 7x. Okay. for it to be just comparable to our other candidates. Okay. To some of our other candidates. So now I think my point is, once you have a framework, we no longer have to talk about these things in vacuum or just spit out opinions. You can have a roadmap to evaluate things with a certain benchmark or make comparisons, right? Even though these comparisons are also highly subjective, because there's a judgment involved in terms of how high do you think the potential this thing can go, right? But I'm telling you, just the second criteria risk for Ethereum is bigger. To me, it's definitely bigger because you're not sure if the blockchain gonna be the infrastructure layer for the future internet values. And frankly, right now, we are not seeing a lot of evidence, right? Because aside from all these DeFi financial engineering stuff, and stablecoin, which the primary use case is money laundering. Aside from that, are we seeing substantial real life use cases for the blockchain-based financial system? Or at least not yet. Okay, so if we still don't see it, if I still don't see it, at some point in the next quote unquote cycle, then that's going to make me seriously question whether that's going to happen. Okay. But it could just like maybe it takes some like risk taking appetite to pick up in order for people to look at this, for this system, for this network to get a lot more liquidity in order for it to become attractive as a base for financial products that have a real use case. Okay, so maybe it just takes another bull market. Maybe it takes several other bull market. I don't know, but bottom line is, my point is, it's got a higher risk. Okay, so to me personally, that just made me think that if I'm going to invest in Ethereum or other kind of blockchain layers, I will rather do it as a cyclical investment rather than this type of buy and hold long-term investment. Okay, but again, that's for me. Everybody's different. Okay, so that's all for today. And again, if you are listening to this on Apple Podcast or Spotify, please leave a rating or a review. I would really appreciate it. And if you are on YouTube, don't forget to like the video or post a comment. You can also subscribe to my free newsletter at taschalabs.com/newsletter. And I will talk to you next time.